Welcome back to 7-Minute Options. Today I want to take a quick look at an earnings play in Best Buy. So today is May 26th. We got Best Buy here reporting earnings tomorrow before the bell, right? So May 27th before the bell. And there's a couple of things that stand out here when I look at the table here. The options chain is, you can see the volatility dropping from 95 immediately after earnings all the way down to 38, right? And so the reason why the volatility of the options in the near term, like in the next month or so, is much higher than it is in back months is simply because there's a lot of news that's going to come out tomorrow in the earnings report, and it could send the stock higher, it could send the stock lower. And if we look at what happened in the previous earnings report, that was this February. So here we are, May 26th. This was the last earnings report in February, and let me zoom in on that one a little bit. So that's this one here. And you can see in February there was an earnings. You can see the volatility went up right before earnings, and boom, it dropped big time, right? But as if you look about 5 or 6 days later, it kind of came back. And so what I want to do is I want to sell a bunch of options here. That's 9 days away, right? So if they're reporting earnings tomorrow, then this is gonna expire 8 days after earnings, which means I'm gonna have at least a week for the stock to settle a little bit after earnings. So notice that if you were to sell the one that's 2 days after the earnings announcement, the stock here in February, in the most recent earnings announcement, right? The day of, boom, it dropped like crazy, and then the next day it dropped further. So if your option would expire right there, you wouldn't give yourself time for the option to come back. So you want to give yourself time to be right. You want to give yourself a little bit more time for it to come back into your zone, right? So that your options don't expire in the money. That's why I don't like to sell it just a day or two after earnings. Yes, the option pricing is richer for that reason, right? Now, here the options in this chain are priced at 94 vol. Down here, they're much lower. So obviously, I don't want to go out 51 days because this is 37. There isn't much lower this volatility is going to go. So, for example, 51 days, this option is not going to benefit at all from the volatility crush following earnings. It's these ones here, right? 55, 47, 44. 3-4 days after earnings, this volatility is going to come back down to the 38% level, or at least that's our expectation. All right, so let me look at this options chain here. If I look at this one here, 2 days away, you can see the expected move is 6 points. The one that expires 9 days away, the expected move is 7 points. So because this one expires after earnings, let's assume that for simplicity's sake, that the expected move because of the earnings announcement is 6 points. So let's look at a 6-point move in the 9-day chain, because again, our expectation is that it's going to move up or down quite a bit because the earnings announcement, we don't care which way. And then it's going to come back a little bit toward the mean and for a few days, and then we can collect. Now, usually if this was not an earnings play, we would have to hold this for like 20, 25, 30 days to reach 50% profit. But because of the volatility crush after earnings, we can expect to collect here in a matter of 2 or 3 days if we're lucky. All right. So let's go look at today. Right now, we're trading at exactly 117. So if I look at a 6-point move, that brings me 111. I like to go a little bit further. I like this one here, the 19 delta. That gives me, if I look at the midpoint there, $111. And I'm going to collect more than $1 on purpose, because if I collect more than $1, then that means I have no risk to the upside if I just select a $1 credit spread here on the call side. So let's say I want to go 22 delta here. So I go 125, 126. I collect a little bit of credit for that. You can see not much, right? But I'm only taking $1 of risk to the upside, but I'm collecting more than $1 on the entire trade, which means there is no risk to the upside, right? So if I look at this here on the curve, you can kind of see, come on, let me zoom in a little bit here. There we go. So that's where the stock is today. After the earnings announcement, it's going to either go high or low, and then it's going to come back. And our goal is to end here. So if it ends in this stretch here between the 125 and the 109, we can collect the maximum 128. But again, I'm going to exit at about 50 or 60% of that. But look, it doesn't matter how high it goes. I have no risk to the upside. If it blows past 127 and doesn't come back, and it closes at 130 or 140 a week from now, that's fine. I can still make $28 here is my maximum expected profit there. And actually, if the stock goes up there, I might even be able to close it a little bit higher than that. So either way, there's no risk to the upside. The only risk I have is to the downside. And my plan is if the stock crashes to the downside and doesn't come back like it did in February, I'm just going to close out this trade here, probably for close to the maximum $20 or $30 on this credit spread. I'm going to close that out, take that $30. I'm going to take this put spread and just roll it to the next monthly expiration. And that is the plan. So let's see if I can fill this one. Go back to the table. 109, 125, yeah, 19 delta here, 22 delta there. No risk to the upside. There is risk to the downside. Now I'm giving up $1,600 of buying power, yes, but hopefully I'm only doing that for the next 5 or 6 days max, and after which I can close this for 50% profit. If this really moves against me, I might need to hold this for a while longer. But let's see if I can close this out at 126. And it filled. Fantastic. So there we go. There's my position. And you know what? I'm just going to take this. See if I can close it. I got $126 on it. It cost me $3 to open because each position is $1 to open. Free to close on Tastyworks. Thank you, Tastyworks. All right, so let's say half of that would be like 64. So let's say I want to close this out for 50 bucks, a little bit more than half. I think if we got the earnings, if we get the IV volatility after the earnings report here, I think we will be able to buy this back for less than half. So that's good. So my goal here is to take $70 of profit in about 4 or 5 days. All right, wish me luck. I'm going to set this to good to cancel. Send it so I don't have to worry about it. And if I'm lucky, maybe 2 or 3 days later, I'm going to wake up in the morning and it'll just be sold. All right, that's 7 minutes. Thanks.